Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsati here, and today we have a very highly high profile guest with us, who's got 30 years plus experience across financial markets across the globe, and who is responsible for managing the wealth of some of the top families in the country. And he brings to the podcast a whole huge wealth of experience in managing portfolios, managing markets, and making sure that all his clients have the best risk return profile that he can provide. I'm introducing you to Vipul Shah, who is the co-founder of Impact Wealth Advisors. Hi, Vipul. Thanks for coming on to the podcast.
Thank you, Arjun, and thanks a lot for bringing me on this platform.
Yeah, welcome. And the title for today's podcast is Challenges Faced by Wealth Managers in Building Fixed Income Portfolios for Their Clients. So, just to give you a perspective, the bond markets have been clearly, the last 3 years have been extremely volatile. You saw interest rates going down to record lows, then coming back all the way up very sharply higher. And this has caused a lot of angst amongst investors who had invested 3 years back. Wealth managers who have seen this uptrend, uptick in yields, who have positioned their clients' portfolios correctly, are now helping their clients reinvest their portfolios so that they can get that extra returns that is available in the market now, and also prevent all the losses. And with many other factors that is happening, one is global inflation has really spiked and not seems to be coming down. The second is you have the economies are doing very well in one sense. Then you have some geopolitical issues happening somewhere else in the world. You have China that is all over the place. Then India is itself seeing some very positive trends in terms of being included in the global bond index. So all this put together is definitely a challenge for wealth managers who are advising clients. I'll leave this to Vipul to actually let our listeners know what kind of challenges he faces when he's constructing a portfolio for his clients.
Thanks, Arjun, and I think you set a context very correctly. Maybe I'll also add a little bit to what initially what Arjun you have said, and then I'll drill down to the challenges which we have in building the portfolios on the debt side. But I would say one more thing, Arjun, what we believe is changing is that we believe that world is now going through a transition. We've seen probably last 30 years very benign interest rates and benign inflation for a very long period of time for various factors, which we believe are slowly unraveling. And now we are moving in a direction which would be a kind of a moderate uh, or a higher level of inflation and a higher level of interest rates in coming decade than what we have enjoyed for past maybe at least a decade or more. And I think that is a very important context which all of us need to keep in mind, especially for people like us when we are setting clients' debt portfolio. Because as you would understand that for every client, the core risk, especially when he is trying to address his asset allocation, is beyond growth. Key to risk, which we always believe he has to balance it out, is inflation, and which we tend to ignore, especially in India, because we've not seen that at all, is what I call also deflation. But we have seen enough parts of world now which have gone through this, and we know that in such situations, having a correct asset allocation at those points of time is so critical, because it's otherwise very difficult to beat a deflationary environment. So, keeping that context in mind, I would say that in current juncture to build a debt portfolio for an HNI client is definitely fairly challenging, especially as another big event which in last 2 years has happened, which is the tax neutrality, which took away all the tax advantages which one had either in form of tax-free bonds, which were earlier issued, or debt mutual funds, or market-linked debentures, or whatever other benefits which investors were having. So now one has to look at it more from a lenses of pure return risk parameters because there are no other major lenses left to really evaluate from. And in that context, one has to balance both reinvestment risk because one cannot keep the portfolio too short dated also because then in this kind of an environment where we move from inflation to deflation also so quickly, like I was just recently reading last 6 months we had a negative WPI and now we are slowly edging against towards a positive WPI in India, despite
Yes.
CPI being so
Hmm.
high, which means that eventually even CPI may start falling down if WPI remains so negative. So point is that it's a fairly dynamic situation and a lot of time we advisors, clients lose sight of such risk which are not there immediately on the horizon, but they can hit you very quickly. Second thing which we
Absolutely.
also face a big challenge in an Indian economy when we are building debt portfolios, and especially now with debt mutual funds as an alternative losing its shine, is that there is still not so much of depth in the debt markets. We don't have so many alternatives to go and select from when it comes to direct bonds. Largely, if we see majority of bonds are issued by financial sector companies, very limited flow from manufacturing kind of a sector, and very limited, I would say, from service sector. So that also constrains, because eventually you are taking a one sector kind of a risk by investing too much of debt into finance company bonds, which you need to de-risk from a client's perspective. So answering your question that how do we manage this challenge? I think we are slowly adjusting to this new reality of tax neutrality. Uh, we are really,
Yeah, coming to this
sorry, yeah,
point, Vipul,
yeah,
sorry to interject. Coming to this point, this whole tax neutrality, and like you correctly explained, the whole challenges faced by the uh, in terms of the way the global inflation and many other macros are moving, and also faced by wealth managers in trying to address. It gives I would, the way at INR Bonds sees it is that it is the best opportunity for advisors like you who clearly understand, are able to gauge what works best, what doesn't work best, go with product wise. Because earlier you were competing with a whole host of the market that was what I would call lazy investing, right? You
correct.
work out the post-tax returns and then you showcase, right? And but now when you have to start thinking and learn capabilities and get the right kind of experience which you people have, I think it gives you the greatest opportunity in getting a very large share of the market in terms of managing fixed income portfolios. Would that be right?
No, I am totally with you, Arjun. And I would say that all of us who are in the industry, and I would say people like you, INR Bond, etc., are doing an excellent job. It's beyond, I would say, it's like helping the really investors and economy in that sense by building such kind of platforms. But yes, it's slowly evolving. I would not say that, all the nuts and bolts which one needs to build a portfolio very easily is still in place because I think there are two, three issues which we still face as a quite a kind of a query or a question from clients' perspective. One is liquidity, because unless you are typically an investor in bonds today with a buy to maturity or buy to hold kind of a thought process, otherwise using bond markets still is very tricky because it's not so easy to get out of it. The depth is still limited, and that's where people like you, Arjun, INR bond as a platform, maybe regulators, if they build more liquidity, because see what really I've seen attracted a large chunk of money from investors moving away from real estate to equity was pure liquidity. They all understand the risk to certain extent. Fine, they may get colored in short period of time by seeing very high returns, but I'm sure that that balances out in long periods.
Yeah.
Where the
Yeah.
bond market, we are facing challenges that today, if I want to make a client invest into a bond, let's say a few crore rupees, and for whatever reason he needs that money for some other business opportunity, it's not so simple to get out of it at a fair price. I'm not saying that there
Completely
is no
agree.
liquidity, but
Yeah.
that fair price which one gets in an equity market is still missing. And that's where, Arjun, I see a little bit of challenge which needs to be addressed as we go down the curve.
Completely agree with you, Vipul. And in fact, the one of the main reasons why INR bonds itself has started this online bond platform is making one is letting people in buy and sell, and the second is providing enough price transparency so that
Right.
investors know exactly where to what is the price they're getting when they both enter and exit. And with SEBI giving more and more importance to depth of the market and coming, and one of the primary reasons for lack of liquidity in bonds has been the absence of electronic bond platforms. And
Hmm.
now with more platforms coming in, more information, price visibility, and more products as well put together, liquidity should start to increase, and platforms will play a very constructive role in increasing this liquidity for your clients. But yes, the 2 points that you highlighted, one is that we do have to live with the fact that most very large percentage of bond issuers are in the corporate bond space uh, are lenders, and and the second is that the liquidity and price transparency. Now both the latter is one is definitely going to improve. The former, in terms of the lenders being a very large part of the issuing community, now with the the focus given to InvITs and rates by the government, for example, right,
Right.
capex for building up infrastructure, and for this they definitely need to get markets involved in funding this capex, and InvITs are going to be a very large part of this funding. And in fact, some of the points we have put out in our podcasts, like talking about power grid, the volatility, power grid InvIT, the volatility, how investors need to know exactly what they're getting into,
Right.
and also on rates as well. So more and more such bond ETFs and more such products come into the markets. It will have a large variety of products available for your investors. But just
So,
coming back to a very
yeah,
core point, Vipul.
yeah.
Now, what is the how, in your own opinion, what is the what kind of importance is fixed income to your client's portfolio?
So let me, Arjun, break it into two parts. Okay. When I say two parts, means I would say two set of investors. Uh, Today, still the kind of target audience we deal with, being HNI, is largely growth oriented kind of investors. And for them, debt investment is more a tool for diversification. Diversification from a risk of a single asset class or a too much of a pro growth portfolio, which would be ideally equity and real estate. And if, let's say, economy goes through a bad patch, then they would face a huge volatility challenge and liquidity challenge when it comes for their equity and real estate portfolio. So to diversify that risk, they naturally want to invest into debt, and hence debt is going to remain a very integral part of their portfolio. irrespective of how equity markets behave. That's one type of investor. Then there is another type of investor, which still in HNI space, I have seen smaller quantum, but I see a huge quantum emerging in mass affluent and retail, which is what I call the retirement class. Because somewhere, Arjun, we fail to understand or recognize that despite India being a fairly young population country, it is also growing or having a large graying population, and which will just explode in coming 10, 15 years, and which needs regular income. It is not requiring beyond a point high growth. It needs regular income. And where does he get that from? Because bank FDs, as all of us know, post real or post inflation, the real returns are very limited. Post taxation, the real returns are very limited. So I think that is a space where we are seeing slowly within, I would say, some category of HNI and more of a mass affluent and retail segment where there is a huge demand emerging for bonds or debt instruments, if I were to use more that as a generic thing, and which is where I believe there is a big opportunity.
Yes, absolutely. Fortunately, I think two things that are happening. One is if you see the new private placements and public debt issues are coming, there are a lot of monthly coupon options. So that
Right,
is actually provides a monthly income. And
right.
also now with more issuers coming on to the debt IPO market and retailing bonds for investors. Now private placement is minimum of 1 lakh face value, and public debt issues the minimum is 1,000 rupees face value. And GSECs are also now available to investors for through platforms. These are all smaller investments. So there, in that sense, there is from even last year to this year, there's been a very large change in the availability of products which can cater to the kind of coupon flows or cash flows that different set of investors require. Yeah, and so hopefully that will help this whole new class that you're talking about, and invest their savings correctly for regular income. Coming back to on the fixed income portfolio side, uh, people now we are seeing a lot of ultra high net worth individuals, clients going to embracing AIFs that are offering post tax returns of say 8-9%, largely high yield portfolios 15-19%. And then there is this category, this is like looking at 9 to 12%, 9 to 13% investments in bonds. Then you have below that, you have below 9%, you have AAA bonds and GSECs, right? Now, in what would be an ideal portfolio for you if you're looking at giving a portfolio for your investors with a risk return profile, and what would you look at in terms of a portfolio yield, maturity, and the liquidity as well?
So, Arjun, there, what we are trying to do is we are trying to do something similar to what one would do in his equity allocation, which would be, let's say, creating a mix of large, mid, and small cap, if one were to use that as a term. Similar manner, we are trying to build portfolios for investors who uh, really understand some amount of risk within the debt asset class, of building a kind of a portfolio between a triple A, single A, and a triple B kind of a category. And as you very rightly said, there is a lot of, I would say, the flavor of market is all this credit risk funds, which probably are in that triple B kind of category. So our thought process is that we should break it into two components, which is both having a balanced mix of duration so that we have a decent hedge to reinvestment risk, and then spreading the risk basket across the three segments so that one doesn't really have excessive exposure to one category of risk especially when, let's say, economy goes through a kind of a challenging period, which one had seen during COVID periods. So that's how we are trying to do that. We are trying to guide our clients of also having some kind of this credit risk kind of an exposure. Both there also, as Arjun, you may have seen that there are now a lot of interesting opportunities coming in direct investment, not only through funds, but directly investing. And there are a lot of interesting platforms which are emerging with well experienced people setting up such kind of an opportunity. So we are trying to see if we can work with those kind of talented skills in co-investing, also looking at some such funds, and then looking at this single A to triple A kind of a category, using people like INR bonds to find liquid bond portfolio, so that that balances the mix between liquidity and illiquidity through the whole cycle.
Absolutely. And just what where do InvITs and REITs and we don't have one except for one bond ETF, we don't have too many big ones. Do they find ways into your portfolios?
Yes, Arjun. REITs and InvITs definitely are there in our clients' portfolios. So REITs typically for clients who do not want to have direct real estate on their own, because as you know, historically, Indian HNI clients tend to have a fairly large exposure to direct real estate by investing into commercial assets and letting them out themselves. But slowly, I'm seeing that the new generation of investors which are coming with new wealth, they don't want to get into too much of complexities of managing this direct real estate. And hence, for them, REITs is emerging slowly as a decent asset class. Unfortunately, from the time these REITs have hit the public markets, they've still not demonstrated that kind of high growth or a decent return. And hence, there is some nervousness, but I'm sure that that will play out as we companies build enough net operating income by adding more leased assets. But on the InvIT side, we had a fairly good experience. But within InvITs, we have seen that the toll roads, there was only one InvIT which really was there, and which also had fairly volatile journey, but still a decent return. And in the, I would say, the Power Grid and India Grid InvITs, both have gone through its own challenges, because again, the regulator keeps changing things. Like a classic example in Power Grid, as you may have seen, is that the regulator has come up with certain changed in tax laws by which the InvIT is not able to add new assets which it was expected to add, and hence the prices are going through some set of correction. So, but there is a fair bit of interest in this asset class, and as it deepens, I'm sure there is a lot of money which can flow into this segment.
Absolutely. I think a couple of things on rates and InvITs, which we are really focusing on, is more and more of information and education, and seeing if the prices are what would be the for example, what we see it as is a fixed income product and not an equity product. And if there is extra kicker in terms of growth, then that is just an option. But it's not that's not the way, right? The pricing, it is going to be very important for investors, and more importantly, understanding where to invest and when to invest, so when to exit as well, and liquidity for larger investors. So hopefully bond platforms can start to offer such kind of liquidity for large investors in InvITs and REITs, because I believe we do provide the best information on such products. Yeah, that's very interesting to know.
Maybe there are also a lot of unlisted probably REITs and InvITs which could also be eventually platforms like yours can provide some kind of liquidity and research on it, which can also expand the market.
Yeah, unlisted as online bond platforms, we can only deal in listed REITs and InvITs. But the way we see it is that given that every product gets better liquidity when listed, and if there is more liquidity, there is better. In fact, many issuers can actually get better prices, maybe which is more in tune with their fundamentals rather than market factors. So we would see that more and more bonds and products are getting listed rather than staying unlisted, which is actually good for your clients, because the point you mentioned on liquidity is very, very important for listeners here. That the better the liquidity and the more comfort you have, and the more comfort you have, the more comfort your clients have. And
True.
when your and prices are more transparent when there is more liquidity. So in that sense, I think we would see more and more products that are getting listed rather than stay unlisted. That's the way we see it. Yeah.
That's excellent.
And any any closing thoughts, Vipul? Any on where you think the primary challenges that you face and how you're addressing them for your clients?
I would say, Arjun, two areas where we feel there is emerging opportunities. One is that, like you initially mentioned about bond ETF, that as a space we believe could really expand going forward. Like if one were to look from a retail to an even HNI segment, today for him to do a thorough due diligence and research on bond markets, there is still limited resources available, like unlike equity where there is enough and more research available. And hence, platforms like INR bonds, etc., if they can create some kind of quasi, if I were to call ETFs, where you can have a basket of AAA bonds or a AA bonds if one was to buy, well researched by such platforms, and who because of their past strong track record gives a conviction to investor, then that helps in diversifying, because today a client also is little afraid of taking exposure to one single uh,
Credit.
company.
Yes.
And this kind of a diversification, like what we have seen in equity, there is a innovation called small case portfolios, where a lot of
Yeah.
people come up with their basket of ideas. Similarly, why can't that be done in the bond markets? It could be an amazing opportunity for a lot of people to go and invest into such well researched baskets, and platforms like yours can provide that liquidity for them to go and buy. So that's one area where we feel something can be really looked into. And second, as we
Uh,
discussed initially, is the liquidity part, which I guess, as you are indicating, slowly will emerge, which I guess will really deepen this bond markets as we go down the curve.
This is absolutely possible, Vipul, and we are definitely looking to attempt, such kind of baskets and portfolios that we can provide from the bonds that are listed and offered on the platforms and in the market as well. And you must have seen globally itself, ETFs are the biggest draw for fixed income
True.
investors. And hopefully, with India now being included in the global emerging market index, and India will be part of many, many bond ETFs that are tracking sovereign bonds. Um, and so hence ETFs too will gain a lot of flavor in terms of understanding by investors. Thank you very much, Vipul. And it's been a pleasure having you on the podcast. And I'm sure our listeners here would have a lot of takeaways from your insights into the challenges faced by your investors and how you are addressing those challenges. And yeah, I hope to see your firm grow and grow and grow. Yeah.
Thanks a lot, Arjun. Again, thanks to your team for having me here, and wish you and your team also the very best.
Thank you, Vipul. Yeah.
Thank you.